Welcome to The Explainer. So today we are going to unpack something absolutely fascinating that just played out in the financial world. We're breaking down Bill Ackman's latest portfolio shift to uncover a really critical lesson about investing. And specifically, we are going to look closely at a trap that catches even the absolute smartest minds on Wall Street, the immense make-or-break impact of market timing on your returns. We'll see exactly how a bad entry point can completely ruin a phenomenal investment, and how truly understanding this changes the entire way we should look at the market. Let's get right into it.
So you have to ask yourself, why on earth did Wall Street's most famously concentrated investor just spread his chips across 6 totally different industries? Now, Bill Ackman, through Pershing Square, is legendary for making a very small number of massive, highly concentrated investments. He usually hunts for a very specific type of business, ones with bulletproof brands and incredibly predictable cash flow. But recently, he raised a ton of capital through Pershing Square USA, and instead of just jumping on the latest artificial intelligence bandwagon or, the hottest semiconductor trend, he spread his debts across what honestly looks like a totally scattered board. Why the sudden shift?
Okay, let's dive into this and look at the actual lineup of the 6 multi-billion-dollar investments he just made. We've got Netflix in streaming, Visa and Mastercard in digital payments, S&P Global in financial data, Intercontinental Exchange or ICE, which literally runs financial markets, and then Alcon in healthcare. At first glance, these 6 companies look completely unrelated, right? Like, what does a streaming giant have to do with an eye care company or a stock exchange operator? If you're just skimming this list, it looks totally random. But as we're about to see, Ackman might not actually be betting on 6 different companies at all. He's actually betting on one much bigger, unified idea about exactly where the next decade of money is going to be made.
Now, what's really interesting is how we typically view Visa and Mastercard. We usually see them as these fierce, head-to-head competitors fighting for the plastic in our wallets. But Ackman deciding to own both, it isn't about trying to pick a winner between rivals. It's a massive, unified bet on infrastructure. Just think about their business model for a second. They don't have to manufacture a brand new product for every single purchase, they aren't out there building physical stores, and they don't even take on the credit risk of a traditional bank. They just operate the massive global networks that connect the banks, the merchants, and us, the consumers. By owning both, Ackman is just betting that more and more commerce will move online, and the world is going to keep transitioning to a cashless economy. He doesn't need to predict which payment app wins the tech race, he just owns the toll roads.
And that exact same toll road philosophy applies perfectly to his next 2 bets, S&P Global and Intercontinental Exchange or ICE. Now, you aren't going to see these companies trending on social media, but they run the absolute critical plumbing that global financial institutions depend on every single day. ICE operates the actual marketplaces, like the New York Stock Exchange, where billions of dollars are moving, trades are executing, and risk is being managed. S&P Global provides the ratings, the analytics, and the data that banks and governments rely on to function. And here is a super fascinating detail. While a lot of people are panicking that AI might replace traditional financial research, Ackman's bet tells us that in an AI-driven era, trusted, rock-solid data becomes even more valuable. Because AI can crunch the numbers all day long, but somebody still has to provide the verified truth.
Then we have the 6th investment, Alcon. This is a massive global eye care company. It definitely seems like the odd one out, but it actually reveals another huge piece of the puzzle here. Healthcare demand, particularly for vision and eye health, well, it isn't driven by economic excitement or flashy tech breakthroughs. It doesn't care if the stock market is having a good day or a bad day. It relies entirely on long-term demographic demand. As global populations age, people are simply going to keep needing eye care. Full stop. It's a business with built-in, long-term demand, incredibly strong market positioning, and predictable growth that is almost entirely insulated from the crazy market cycles that bounce other industries around.
So the crucial point we're getting to is, there's a hidden pattern connecting all 6 of these totally different businesses. Ackman isn't out there trying to predict the next revolutionary technology. Instead, he's hunting for companies that hit an exact, rigorous checklist. They are already deeply embedded in their industries. They have massive recurring demand. They operate incredibly powerful networks. They generate highly predictable cash flow. And above all else, they are incredibly difficult to replace. Ackman isn't necessarily betting on the future. He is betting on businesses that are just too important for the future to replace. But as we are about to see, identifying a great, irreplaceable business, well, that's only half the battle.
$400 million. Let that number sink in for a second. That is the estimated loss Ackman previously suffered on just one of these exact companies. Because here is the harsh, unforgiving reality of investing. Finding a great company means absolutely nothing if your timing is wrong.
And that brings us to the core focus of our explainer today, the incredibly dangerous trap of market timing and how it can completely obliterate your returns. To really understand this trap, let's look at what we can call the Netflix saga. Back in early 2022, Ackman bought a major position in Netflix. He completely recognized its massive international audience and its sheer dominance in global entertainment. But then, the stock collapsed, hard. By mid-2022, Ackman sold the investment, taking that massive $400 million hit. For most investors, that's the painful, embarrassing end of the story. But cut to present day, and he has made a massive return to Netflix, bringing it right back into his portfolio. Why? Because Netflix still has incredible free cash flow and totally new opportunities opening up through advertising and pricing adjustments. His initial thesis about the company's dominance wasn't necessarily wrong at all, but his entry timing? It was devastating. It perfectly proves that a bad entry point completely ruins your returns, literally no matter how good the underlying business is.
It all really boils down to this one harsh reality. A great company doesn't automatically mean a great investment. Price matters. This is the absolute ultimate lesson in market timing. You could identify the single most durable infrastructure company in the world. You could find a business that sits right smack in the middle of millions of daily transactions with a flawless competitive advantage. But if you buy in at the absolute peak of market hype or at an absurd valuation, your investment is still going to get destroyed. Your entry price and your timing dictate your returns just as much, if not way more, than the actual quality of the company itself.
And hey, if you think this is just some beginner's mistake, think again. Even the absolute legends of Wall Street get the timing wrong. Pershing Square USA is actually traded at a discount to the underlying value of its holdings recently, and the fund's overall performance has faced some real pressure. It's a stark, real-world reminder that billionaires face the exact same timing traps and performance pressures as the rest of us. The market frankly doesn't care how famous you are. If your entry point is off, your returns are going to suffer. Period.
Which brings us to the true definition of a value investing strategy in today's context. Ackman's big return to Netflix relies heavily on securing a much better entry price this time around. The strategy isn't always about scouring the earth to find some completely unknown, top-secret company before anyone else does. Often, the greatest opportunity is just finding a massive, highly visible, undeniably great company that the market is just temporarily misunderstanding. Ackman clearly believes the market is currently underestimating Netflix's long-term economics. By waiting patiently for the market to misprice a truly great asset, you solve that timing equation and set yourself up for vastly superior returns.
And this brilliantly illustrates exactly why simply copying billionaire investors is so incredibly dangerous. When a famous investor's portfolio is finally revealed to the public, retail investors constantly rush in to buy the exact same stocks. But guys, you are flying totally blind. You don't know their exact entry timing, you don't know the exact price they paid before the news broke, you don't know their target holding period, like are they holding this for 10 months or 10 years, and you certainly aren't going to know when they plan to exit until long after they've already sold and moved on. Without mastering your own market timing and deeply understanding the thesis behind the price, blindly copying trades is just a recipe for disaster.
So as we pull all of this together, what is the real actionable lesson we should take away from Bill Ackman's 6 big bets? The true takeaway is that incredible value usually isn't found in the flashiest, most hyped-up companies making daily headlines. It's found in the boring, irreplaceable infrastructure companies. It's the ones quietly collecting fees in the background, serving millions of people who rely on them daily without even thinking about it, and becoming structurally harder to replace with every passing year. But, and this is the absolute key to everything we've talked about today, they are only great investments provided you buy them at the right time and at the right price. Which leaves us with one final pretty provocative thought. Did Ackman just perfectly position his portfolio for the next decade of business? He essentially bypassed the entire AI craze to lock in the absolute bedrock of the global economy: payments, entertainment, financial data, stock exchanges, and healthcare. He's made his bets on predictability and permanence, attempting to execute the right timing on these heavyweights. Whether his timing proves correct this time around, well, only time will tell. But really understanding his playbook and those massive hidden risks of market timing we discussed, that completely changes how we should look at our own investments. Thanks so much for joining me for this explainer, and definitely keep these lessons in mind next time you're looking at the markets.